The Big Beautiful Bill Act is in, everybody. So it's a go. It's confirmed after much deliberation and after so much back and forth. It has been approved. So we can confirm that some of the things, that some of the provisions, some of the reforms that had initially been considered, some of them got passed, some of them got kicked out. So today, what I want to do is I want to talk about what this big beautiful bill means, what it can do for you, why you should care. So first of all, my name is Julian Gonzalez. I'm a CPA and founding member of Upfront CPA. We're a CPA firm, and what we want to do is we want to help you, the business owner, the individual. We want to help you that you save on taxes, that you don't overpay taxes. That's the one thing we want to do. Okay? So, very important, right? So today's like the Super Bowl for us, basically, for us accountants. It's like this bill. It's huge. It's been back and forth. It's been all over the place, right? It passed the House a while ago. It got sent over to the Senate. The Senate had its revisions, and now it has been signed by the president. So it's formal. It's confirmed. So what does it mean for you? That's what I want to talk to you about today. Okay, in this video, I set it up so that I divided it basically in three parts. Okay, number one is the individual. Okay, what you should be looking at in the individual basis. Then there's the business side of the bill, and then lastly, I want to talk about the real estate and investment. Okay, a lot of realtors and investment guys, you folks, you do want to listen to this. So without further ado, let's begin. So in the individual side, what this bill does for you is basically what they wanted to do was they wanted to compress a lot of these issues or a lot of the complexities that come with the taxes and some of the things that were due to finalize because of the timing, right? So this year, some of the previous tax reforms were becoming undone. So what this bill does is it rolls over some of those provisions that were gonna expire. And first of all, and very important, what it does is trying to incentivize and make a push at the economy. Okay, it want to boost the middle class. It's looking to simplify the tax code and keep more money in your pocket. But what you want to do is you do want to talk to your accountant, okay? Because if you don't prepare for this, if you don't strategize, you're gonna pass up on this huge bill that was meant for you. So just make sure that you take advantage of it, because if you, it could happen that just because you didn't prepare, then you don't take advantage. And that's what our Upfront CPA don't want you to do. Okay, so let's begin. So first of all, on the individual side, okay, so what does it do? The first thing, the tax brackets get adjusted. Okay, so what does that mean? That means that every bracket is gonna get a lower percentage. Okay, so they've been compressed. So for example, at the top rate, it was gonna become 37%, so it's now back down to 35%. Okay, so they so even the lower ones get compressed by at least 1%. So what does that mean? Simple. You just get 1% more of your money. Okay, that doesn't go to the IRS. Okay, so this is very simple. Okay, so whatever bracket you're in, you're expected to pay less. Had this bill not passed, you'd be paying 37%, but now it's back to 35%. So this should be tax savings for you, especially middle class earners. This is a huge deal. It can be up to like somewhere around $2,500 that you're looking at about average that you should be saving with this bill. Obviously, it depends on wherever your situation you're in or how much your income is. But average speaking, that should be about a pretty good number. Okay, so that's number one, the tax bracket. Number two, standard deduction increased. Okay, this was one of the big ones. So for those of you that don't know, so you have either the standard deduction or you have the itemized deduction. Okay, so it depends on the situation, wherever you're, even in your where you are geographically, what state you're in, that enters into how you're gonna strategize if you're gonna use either one. You cannot use both. You gotta use either one. So the standard basically it gets increased. Okay, so it went to $30,000 if you're married. Okay, or $15,000 if you're single. Goes up from $13,850 if single, or $27,700 if you were married. So it went up by somewhere about $2,300, the standard deduction. So what does that mean? Basically what that means is if you're married, the first $30,000 that you make, you don't pay any taxes on. That's tax free. Okay, so this is a pretty good number, considering that in the past it was somewhere about the 12,000. So it has more than double. Okay, and clearly, doubling the standard deductions means doubling what you won't pay to the IRS in terms of percentages on your tax bill. Okay, so this is huge. This is great. We were hoping that this passed and that the Senate wouldn't back down on this, and we are glad that it did not happen. It stayed. So what this is going to happen is that like a few people that were looking to, as I mentioned, you could either use the standard deduction or the itemized. You can use both. So what this does is usually if you were itemizing, this is less likely that you would itemize because you would pick whatever is most convenient for you. So to be able to deduct more than $30,000 in itemized deduction is not easy, because itemized deduction usually includes taxes like state taxes that you might have to pay, some other provisions in there, like mortgage interest rates, stuff like that. There's a few things that you can add to that, and that has to add up more than the 30,000. So less people are gonna be more than the standard. This is good, and it's also gonna simplify the tax process. Okay, so so that's number two. Number three, child tax credit modified. Okay, so what this means is they have reinstated a $2,000 per child under 17 years old. Okay, so there's a bit of a phase out that you gotta watch out for, but if you have a child, you are very, very likely that you would get this benefit. So you make sure you gotta talk to your accountant, and after you do your taxes, make sure that you're getting this credit applied to you. Okay, there was a phase out, like I said, so it could be that you're making way more income and you don't qualify anymore, but make sure that you are attempting to get this credit. Okay, so what that means is like more families are gonna get this credit. Before there was more than a phase out, a lot of people wouldn't qualify of certain situations. Now it's being reinstated. Okay, so, and even more important, if you're in a low income bracket, you can even get a refund for this credit. So this is great. Okay, now so that's with the child tax credit. Another one that is important is the itemized deduction reworked. Okay, so what does that mean? So when I talked about it was either the standard or the itemized, now we're talking about the itemized. So they have increased that too, just so that we make one side happy, we gotta make the other one happy as well. So what they did is they increased the deduction available that you could use for what is called the SALT. And when I say SALT, I don't mean the ingredient salt. I mean SALT, it stands for state and local taxes. Okay, so whereas before they used to cap at, I believe, was $10,000. They have now increased that to $15,000 and $30,000 if you are married. So if you're in a high income tax state, for example, California, New York, those are the most famous or infamous states for charging a lot of taxes. This is big for you because that means that you get to deduct more. Okay, so pretty much that's basically in a nutshell what you should be looking at from the personal side. So this is, all of this is looking to save you money, and you should. So I can't stress enough that it's important for you to check with your accountant, make sure they're up to date, make sure that they're going over every single item that they could go through for you, because this is huge. It has been all of the drama that happened was for your benefit. A lot of back and forth there. So make sure that you take advantage of this. This is on the individual level. Okay? So now moving on to the business side of the spectrum. Okay? So now we're talking about small businesses, medium-sized businesses. Even if you're a huge business, you also get benefit out of this. Okay, so as I mentioned, so this is implemented in order to push the economy, and nothing pushes more the economy of the United States than the small business. Okay, so the small business are the engine of this country, believe it or not. So the 1% high net worth individual, obviously, they own most of the assets of the United States, but the small business takes care of the other side, the 99% of the individuals that don't have $1 billion, right? So one of the things that we here in the United States we're proud of is that entrepreneurship it's encouraged, right? And what this bill does is it encourages you to invest, to grow, and to take your business to the next level. So let's talk about those items right now. So the first one for the corporate side is the corporate tax deduction. So the rate gets deducted. Okay, this is huge. So whereas before, if you own, let's say, a C Corp, your tax rate was 21%. Well, that has been dropped to 19% if you're a C Corp. So what does that mean? Well, you get to keep more of your after-tax profit, right? You get that 2% there that you get to keep for yourself. Okay, so this is huge, and why? It's not always the case where governments actually tell you, okay, don't pay me so much. You're gonna keep more for yourself. It's usually the opposite. Usually these rates go up. So the fact that the rate is dropping from 21 to 19, in my opinion, is huge. It doesn't always happen. I think it will encourage more businesses hoping to be businesses to, first of all, jump into the entrepreneurship if they were thinking about it, or even expand if you already own a business. Okay, so that's a huge one. So next is the pass-through entities and QBI deductions. Okay, I've made a video before about the QBI, the qualified business income deductions, and what does that mean for your business. And in a nutshell is, you get to cut or deduct somewhere in the around 20% of your income. You get to deduct it from when you file your personal taxes. Okay, so the qualified business income stays. Okay, so it is now at 20%. Okay, so this is gonna be a huge impact for freelancers, consultant. If you own real estate, this is huge for you, because with what this QBI does, like I said, is on top of all these other deductions and credits, this credit gives you that if you're bringing in business income into your personal side 20% of it, you don't pay any taxes. So this was a lot of, this was one area where it was debated, and it was, it was possible that they were gonna eliminate it. The good news is that the QBI stays, so more businesses like yourself can keep more of your money. Another one is the Section 179 expensing and bonus depreciation. If you ask me, this is probably the most important one. It's the one I was looking forward to the most. Okay, I think, to me, in my opinion, this is what if when the goal here is to push the economy, nothing is going to push the economy more than this provision, in my opinion. So what does the Section 179 does? And bonus depreciation, what does that do? Well, it means that you, in certain investments, like, for example, your vehicle, equipment, buildings, anything that you can invest as an asset, under certain criteria, you get to deduct 100% of it on the first year. So this is huge, folks. If you're aware, when you buy assets like this, if your accountant was doing it right, you only get to depreciate that over time. Okay, you can't, when you buy an asset, the tax IRS code says that you have to depreciate it over its useful life. Okay, this is important. So in the case of a vehicle, somewhere in the around the 7-year range. Okay, so that's how long you had to depreciate your vehicle. Now, guess what? If you buy that vehicle in 2025, you get the full deduction. So just to give you an example, let's say you buy a $10,000 vehicle. So in the past, you only get to depreciate it over 7 years. Okay, 7.5, whatever the case may be. Now, if you pay that same vehicle, if you purchase that same vehicle in 2025, you get to deduct the full $10,000 that same year. That is besides what you get to deduct for the use, or in this case that we're discussing, is the vehicle. This is one question that a lot of my clients ask, like, oh, but how do I deduct the vehicle? Can I use the miles? Well, it's two different things. One thing is how you depreciate the asset and the investment into the asset, and another one is the daily use. You get to use both. So talk to your accountant about this one. Maybe you can use this video to get some ideas about some of the questions that you need to ask them. Okay, because this can be huge. I've seen huge deductions and savings that I've had my clients that they didn't know about, even after they talk to their accountant. So make sure that you get in this. So what does that mean, this depreciation? Well, you now get to deduct for equipment, as I said, vehicles, office improvements. So this is obviously the clear goal here, is to push the economy, right? So let's say you're owning a business. Let's say you were considering buying a new vehicle. Well, now you have extra motivation, right? Before, I would have to depreciate that over whatever, 7.5, 10 years, all the equipment, however long it took, 5 years. Now you get to use it all in the same year. Now, that comes with also a caveat, right? So that doesn't mean that because you get this provision that you have to use it. You still have the option to depreciate certain things and use the cost segregation strategy. Okay, so why do I say that? Because depending on your situation, it might be very beneficial for you to depreciate, let's say, the full year, or it may not. It depends. Okay, and there's still also that Section 179 aspect that you have to consider. Okay, so this is kind of doing sort of a chess game, right? So if I depreciate all of this year, let's say, well, maybe I don't depreciate the whole thing on year one. Maybe I use some of the 179 section to leave room for more depreciation in later years, when it might be more beneficial. So this is something to consider. We do that here. We do that full cost segregation strategy and formula for you, basically, to determine what is most beneficial to you. Okay, so very important. the bonus depreciation one. Okay, so next is the employment credits and payroll taxes. Okay, so obviously, clearly, what we're trying to do here is encourage the economy to get ahead, to expand, for people to expand, for people to keep more of their money, and clearly to hire more people. Okay, so there's a small business credit, employment credit, that we get up to $2,000 per new hire. Okay, this is brand new. I love this one. So clearly you can see the benefits, right? You get to up to $2,000 per new hire. Okay, you get a credit. This obviously is going to encourage you to, if you were maybe discussing getting a new hire and you were like kind of borderline thinking I should do it, I should don't. Well, now is the time to do it, because if you were doubtful before, you get this extra credit that hopefully can push you over to the next side and give the green light to hire that next person. That it's maybe an expense in a way, but it's also going to help you grow your business, right? That's our intent when we hire new people, is to get more business, right? Is to help us maybe delegate some of those duties that we don't want to do anymore, so that we as business owners can maybe take care of some of the bigger issues, right? Like, getting more clients, stuff like that, client visits, more client facing, maybe do what you want to do instead of, doing some of the administrative work, right? So that's going to help grow your business eventually. Okay, so bottom line, businesses, you're gonna get to keep more of your money, you're gonna get to hire more people, you get to invest and expand. That if you do it correctly, at the end of the day, what you see in tax savings is gonna be huge, but you gotta do it smart. Okay, that's why you need to contact your CPA now. Don't wait till next year. Next year, most people, next year, then it's over. So basically, what these provisions do is they help you with the tax planning that you have to do. So it's not going to hurt you to contact your CPA, talk to them about some of these things that I'm mentioning, maybe even do some research yourself with your company. And it's not going to hurt you. Meet with them. Ask them the questions that you need to ask them. That's where you can see if your accountant is really kind of keeping up to date with these things, so that they can eventually help you. Okay? So, the last but not least, I want to talk about the real estate and investment provisions. Okay? So, as we know, investment is huge in this country. Real estate is a big part of the economy, not only in terms of the housing itself, but also with the whole real estate, realtors industry drives a lot of the economy. So the first one is the 1031 exchange limits. So this is actually one where it's being capped, so at $2 million per year with the 1031 exchange. And for those of you that don't know what the 1031 exchange is, so this is basically when you get to sell a property and buy a new one without having to pay capital gains on that sale, on that transaction. Okay, it defers the gain so that you can keep investing, right? Because obviously, let's say you own a property and you want to exchange it for a new one, it would be discouraging to know that if you're looking to replace that one, that you will have to pay taxes on that sale that you do for that transaction. So what the 1031 does is it will say, okay, you're exchanging a property, you don't have to pay capital gains taxes. You get to defer that to when you eventually get out of that property. Okay, so obviously this is for like high-end investors. They're gonna get that tax deferral, but added it's gonna have that cap right? Okay, but landlords remain usually, they're gonna remain unaffected because this is not intended for the landlord. This is more for on the investment side. Okay, now 2 million is a pretty big number. So this does by no means it means that by no means this should discourage you to consider a 1031 exchange, because this can be, if used correctly, it can be a huge tool to your benefit. Okay, so now next one is the capital gains threshold adjusted. Okay, so this is actually one that has also been sort of a cap in a way. So this is one where like some loopholes are being closed. So long-term capital gains of 15% start now at $100,000 or $200,000 if you are married. Okay, so what that means is, if depending on whatever bracket you're in, having capital gains usually will not start until the gains is over $100,000. So this is pretty big. Now depending on your situation, but this is kind of maybe affect a little bit more to some of the higher income earners, that they're looking at to pay somewhere about 20% for their capital gains, and because the capital gains tax bracket is a little bit different, so it could be either 15% or 20%. What this does, it makes a little bit of a, it makes it more summarized. It makes it more clear where it was before. Before it was like somewhere in the 44,000 or 89,000 what you had to make before you jump into another bracket. So now they just, they've rounded it up to $100,000. So that means that more upper middle class earners will be looking at paying in the 15% capital gains. So this is where like a strategy section is going to help you. Make sure you don't make sure that, first of all, you don't pay short-term capital gains, which is even higher rate. You can also utilize maybe some of the losses that you might have on long-term capital gains to minimize your taxes on a certain year. If you're looking to sell assets or make investments or sell investments, talk to your accountant. Make sure that they go over multiple scenarios, what you could do, possibly avoid a big tax bill, especially when you could have avoided it because you didn't plan it correctly. Okay? Now, on to the realtors. So, the real estate side has also been affected. Okay? So, what that means is they have implemented a bit of a stricter rules and requirements for short-term rentals to qualify as material participation to be deducted, especially if you are a realtor that you own your own home. Before, it used to be what appears to be that it used to be a lot more loose. That was the case. So it appears that they're gonna be a lot more stricter in terms of some of the requirements that they're gonna ask of you to be able to utilize this tool. Okay, so before, it was somewhere around the 100 hours that you had to spend on assessing or working on your property so that you qualified as active. That has gone up, and not only that, but the IRS is gonna ask that you keep and maintain records of the time and the work that you've been put into these properties that you are looking into have as active income into your personal taxes. What does that mean? And I'll back up a little bit because I may have to I will need to differentiate between active and passive. Okay, so what's the difference between active and passive income? especially coming from, like, let's say a real estate investment. So when income is passive, you only get, or let's talk about like in terms of losses. So if you have passive losses, you can only deduct or you can only offset against passive income. So let's say you're a person that has a W-2, you're a W-2 earner, okay? And you have your income, obviously. And so let's say you own a real estate property and you're not a realtor, you're not actively participating, and you, additional to your W-2, you have income from real estate. So let's say that you invested in a Airbnb, did not go well. You had, just to give an example, $50,000 in passive losses. What that means is right now you can only get to deduct either hopefully you have other investments that had over more than that $50,000 loss that you can offset with this, or you can only use $3,000 out of the whole $50,000. Only $3 can be used against your active income or your W-2. And this is huge if you didn't know this, because a lot of our clients didn't know, even working with previous CPAs. So now, if you are a realtor and you're a real estate professional and you're actively participating in your property, well, guess what? You get to deduct whatever the loss was. You can use it fully against your W-2 income. Okay? So, before, to qualify to be the active real estate professional, it was a lot more loose. Now they're putting a few more requirements there that you need to watch out for. Okay, so also, like if you own an Airbnb, if you need rentals, whatever you own, you have to keep close tracks of the hours that you're putting into the property to be able to use either your passive losses or your active losses. So, this one is kind of a bit of on the other side, whereas before, they were being more encouraging. In this one, they're actually putting a little bit of hoops in our way, but doesn't mean that you have to be discouraged and not invest or getting actively participate in your properties. It just means there are a little bit more requirements that you have to watch out for. Okay? Another one is, especially on the investment side, is cryptocurrencies. Okay? So, cryptocurrencies have been always a subject of a lot of uncertainty and a lot of misinformation, disinformation, whatever it is. Just people didn't know what to do about the cryptocurrency. A lot of people were getting their information from TikTok or whatever the case. They didn't know what to do, whether you should report, how were you supposed to report your gains. Was it short term? Was it long term? How do I invest in this correctly? It was always been like a case of ambiguity. Okay, so now what the IRS is now with this tax bill, what they're trying to do is just put a little bit more clarity into what is the requirements for the reporting of these digital assets. Okay, so now if you own, if you have assets or digital transactions for over $10,000, they will need to be reported. So brokers are now going to be required to file what is going to be called a Form 1099-DA. Okay, so that means if you own crypto, and you now need to maintain your records, okay, similar to what if you own other stocks. This it's kind of closing the loophole that's always been present in terms of the difference between cryptocurrency and regular investment. So in a nutshell, this is kind of like in the investment side what you want to do. what you should be looking out for. I cannot emphasize enough the importance that you stay current with this tax reform. Obviously for us, if you're working with a serious accountant, a serious CPA that is looking to save you, they should be on top of this. It should not be difficult for them to maybe that you schedule a consultation or a meeting, and just to kind of make sure you go over what things you could do to take advantage of these reforms, and make sure that you don't overpay taxes. Okay. One thing I did want to mention is talk about the timeline. So for most individuals and most businesses, this will take effect as of January 1st, 2025. Some of the provisions will phase out between 26 and 27. So that's something else you may need to consider when you're strategizing, because you may have a small window to take advantage of this. So make sure that you go through that. Like for example, in the capital gains one, the threshold will apply after November 1st, 2024. So some of them are even backdated past 2025. And like I said, some of the provisions will phase out between 2027 and 2030. So make sure that you kind of put that into, you take that into consideration when you're strategizing with your accountant. Okay, so let's do a bit of a summary. Okay, so what does that mean for you? Okay, so employees will take more of their pay. They will get to keep it. Okay, more of your money into your pocket, not paying to the IRS. Okay, particularly for middle class. Okay, this is a lot of this push has been with all the talk about how the top 1% own so much of the assets. This one is particularly for you, the middle, middle America, how would I like to say. This one is for you, so make sure you take advantage. Okay, so for small businesses, planning opportunities are opening up like never before. Okay, this is why I emphasize so much. Go talk to your accountant. There are so many strategies for you out there. Okay, and then this is not a silver bullet. Okay, even if you're listening to my YouTube right now, there may be it's not a silver bullet for everybody. I'm just talking about how these reforms might affect you. But if you really wanted to dig deep into how it will particularly be beneficial to you, you need to book a consultation, because not everybody is the same, right? You may even be in the same industry, but you may be in a position to do strategies differently. So very important. The investors. Okay, so we talked about the investor and how balancing your portfolio ahead of these changes is going to benefit you. We looked at cryptocurrency, how that's going to change as well. So you have to take advantage. You have to be on the lookout for the new changes if you own cryptocurrency. And last but not least, homeowners and landlords. If you're realtors, so you have to strategize now, right? So like I said, before, if you own your own property and you were renting or short-term renting, and some of the deductions that qualified for some of the provisions, some of them have been more strict requirements that you have to qualify, that you need to take care of. So make sure that you're on top of that one. Okay, so big beautiful bill. It's good news, and you still have time to take advantage of everything. So make sure, I keep repeating this, and I don't want to sound like a broken record, but I cannot emphasize this enough. I don't want you to I don't want you to call your accountant in 2026 and that you think, oh man, I should have listened and gone to my accountant in 2025 and I would have saved so much money. So I encourage you to, if you have any questions, if you are looking for tax strategies, go on my YouTube channel. I'm putting a lot of information out there. You can go to my website, www.upfrontcpa.com. You can book a free consultation there. You can give us a call and try to and arrange a meeting or a consultation with us through that way as well. And guess what? What we're here for is try to say is attempting. We want you to keep some more of your money. Not that it goes to we don't want you to overpay to the IRS. That's our goal here at Upfront CPA, and we want you to take advantage. So I'd like to thank everybody for sticking through the video. Go ahead, and if you haven't subscribe to my channel, and stay tuned for more information. And like I said, go to our website where we're gonna have even more information for more stuff that you may be looking for. Thank you, everybody.